It's just all bad for China. Welcome to Macro Money. And today on our ongoing The Reopening Has Fizzled series, as we look at Chinese economic data, disappoint and then disappoint some more, we're going to be focused on inflation. Now, of course, inflation has been the thorn in the side of policymakers in the U.S., in Europe, and has been a reason for interest rates to have gone up sharply to contain it. Today, we're going to learn about why inflation is a Goldilocks sort of thing. You don't want too little. And if you have too little, that is potentially even worse than too much. At least with too much, you can do something about it. Well, when you have too little, things look scarier indeed. So let's jump in here and have a look at why not only this is a very damning sort of thing for China, it spells lots and lots of trouble for global growth as a whole, lots of trouble for stock markets, and probably amounts to good news for the dollar, maybe the Japanese yen as well. Here is, first and foremost, what is on the menu. We're going to get updated Chinese CPI and PPI numbers today. We had them slump into negative territory, negative 0.3% on the CPI number last month. Here, we're going to look at a number that's maybe positive, looking at baseline expectations, but just barely so, 0.1% on the CPI number expected. The PPI number, which is wholesale inflation, producer prices, essentially, the prices that wholesalers pay for goods that they then mark up and resell, that has been in decline really since the second half of last year. It is expected to moderate a bit from over 5% deflation to down 2.9%, so a little bit better. And what we, of course, will see here will be a very, very important window onto pricing power in China's economy. So as we look through all of this, the operating thought to keep in mind is when people want to buy things from you, the price of the things you're selling goes up because there's more demand. The more people want to buy things, the more the price goes up. This is why growth and inflation tend to go hand in hand. When there are deep discounts, just think of your own shopping experience. When prices are being discounted, it is because you are trying to move things along because nobody wants them, because nobody wants to buy, because demand is weak, and you're trying to bring the price down and then down some more until somebody finally buys whatever it is you're selling and takes it off your hands. When the price of things is falling or very nearly falling, what that tells you is there is no pricing power in the economy, meaning sellers of things can't get anybody to buy them. And where else is economic growth supposed to come from, if not that? This is the fundamental issue at work here. With inflation this low, the story in China is absent demand, weak growth, anemic performance, because nobody wants to do a deal. Nobody wants to be a buyer. And sellers are desperately trying to discount. Now, we see that Chinese economic data has tended to underperform relative to expectations. That fizzling has happened or started to happen already as of April or so of this year, as the reopening in China started to fizzle. You can see the reopening there seemingly got a little bit of a belated start mid-January after COVID restrictions were lifted or started to be lifted in December. From about the middle of July, you can see the data has gotten a little bit better relative to forecasts, which is what this index measures. When you're below zero, you're tending to underperform expectations, which is what happens in an economic downturn usually. The data is worse and worse and worse than expected. And of course, when the index is above zero, the data is better than expected. Here you can see we've been below zero for quite some time, but since about middle of July, there's been a little bit of a reprieve. Unfortunately, that is not exactly all that meets the eye, because what you see at the same time is from about that same period, again, the bottom here, July 17th, well, July 20th, July 24th, so just days apart, we can see that there's been a meaningful downshift in expectations for Chinese economic growth. So ostensibly, what's going on here isn't so much the data getting better, but because this measures data outcomes relative to forecasts, if the forecasts get worse, the data has an easier time performing against those downbeat expectations. So this apparent sign of an improvement seems to be more about the market's coming around to things being terrible rather than the other way around. That we are going to get a little bit of a reprieve on CPI and get a positive number, even if we do get one, and we don't get a downside surprise, as this would suggest, wouldn't necessarily be good news. Because despite Chinese officialdom's protesting and saying that the reason CPI has been negative has been one-off things, and we've heard this word before, transitory things, like food, the reality seems to be much more insidious. Looking at the trend in nominal versus real GDP, we find that, incredibly, real GDP is now above nominal. Now, what does this mean? Nominal GDP is just all the goods and services, the value of them produced in the economy. Real GDP is all of that minus inflation, to get the amplifying effect of just more money and more price rises masking as economic growth out of the equation to get real economic growth or underlying economic growth. To see real GDP above nominal GDP means that growth minus inflation is actually greater than growth with inflation, implying the inflation is negative. Inflation is a negative influence on this calculus. So when you take the difference between real and nominal GDP, you get an implied deflation as of the second quarter of about 1.5% year on year. Again, go back to where we started this conversation. This tells you that there is no demand and prices are being slashed to try to revive it. On the trade front, these were numbers that we just saw updated this week. We can see, again, another month of contraction in both exports and imports. A little bit better than the 9% contraction that was expected for both, but just barely so, especially in the case of exports. It's tough to split hairs between 9 and 8.8% year-on-year declines. It's effectively the same thing. But the upshot in this story remains the same. A loss of domestic demand, hence weaker imports, a loss of external demand, hence weaker exports. And this continues reopening or no reopening. Now, of course, we've talked about this before. The main issue here is that by the time China came around to lifting COVID restrictions in December, their main customers had already lifted them, and the post-pandemic growth spurts of catch-up growth where the economies reopened and reaccelerated after lockdowns in the Eurozone and the U.S., the main customers for China's export engine, that occurred ages before. And the catch-up growth already peaked out in May of 2021 and in July of the same year. in those economies, which means that by the time China came back and said, hey, we're here again, we're open, we're ready to sell you a bunch of stuff, we're ready to rejoin the global supply chain, it had been over a year that these main customers were looking for other supply chains and dealing with growth slowing after it had peaked and gotten a bit of a hand, and maybe not a bit, but quite a lot of a hand on the way down from aggressive rate hikes by Fed-led central banks. Because, of course, that run-up in catch-up growth also meant a ton of inflation. So China never really had its recovery find footing and get off the ground. Because at least on the external side of things, the demand simply wasn't there like it was before the pandemic. And we can see here that we are looking at a diminishing share of global trade for China from the peak right before the sort of reopening asynchronization here that we've just talked about, where the customers came out and had to look for new supply because China were not ready to do that for almost a year, over a year rather, thereafter. China has shed close to 2 percentage points in its share of global growth. So you can see here, global trade overall going down, China trade going down, but China a net loser all the same because its share of the pie has actually diminished. Now, 2% doesn't seem like a lot, but when you think about 2% of total global trade volume for the world's second largest economy, that 2% is a huge number. So this is a tremendous loss of market share. Now, that of course means that China needs to do something about reviving growth via domestic demand, because if the customers aren't there, well, you can't compel them with domestic policy per se. So how do you do it? Well, perhaps you try to boost domestic growth and make up the difference that way, but that has not really worked, nor has a real effort been put out there to try to get it to work. We look at the amount of policy easing that has actually come out of the PBOC, China's central bank. We can see here that since the reopening, obviously there's rate cuts here from COVID era times, from cyclical peaks at 2.55 on the 7-day rate and 3.3 on the 1-year rate. But since the reopening and amid expectations that it's not going well, the 7-day rate has only gone down a mere 10 basis points from 2 to 1.8%. The 1-year medium-term rate has gone down from 2.75 to 2.5. That's one standard-sized cut. Not a whole lot of stimulus here at all. And the response has been equally lackluster. Here are the latest numbers on Chinese loan growth. They are both negative year on year for new loans and total outstanding loans. So clearly, the idea that you were going to pump more money into the economy and get domestic demand going is not working. This, of course, is exacerbated by a flight of foreign investors. We can see here, this is data from the PBPOC itself. We can see that Chinese foreign currency deposits have been dropping precipitously, down from 1.05 trillion, so let's call it 1.1 trillion, give or take, down to 0.82 trillion, so back to levels preceding the pandemic. So this idea that China was going to power the global economy after this reopening is clearly fading, and capital is exiting accordingly. This, of course, is told in spades by what's going on in the currency market here. You can see that officials are really trying to stem the flow out of the yuan and into other currencies. The orange line there is about where the market thinks dollar yuan should be, which is, of course, a much stronger dollar than is being signaled in official daily fixed numbers. This is where the PBOC sets the daily reference rate for the exchange rate. And you have an increasingly wide gap here between where the market thinks the yuan should be, which is that orange line and speaks to a much weaker yuan, than the red line, which is where officials are trying to say it is. And the bars you see there is that widening gap, which tells you capital is leaving or is trying to leave. The markets are voting with their feet. They're saying this is an economy that is anemic, and the authorities are not really doing anything to stem the flow of capital, and they're not really doing enough to pump money into the economy to get it off the ground. And so we're just going to leave. Hence the pressure on the currency. People are divesting of holdings denominated in that currency. And policy officials are desperately trying to slow the tide, but they can only do so much. That's clearly on display here. This is the Citigroup Financial Conditions Index in China. You can see here that above zero is tighter, meaning restrictive financial conditions, meaning borrowing is expensive and scarce. The further up you go, the more expensive and scarce it gets. Under zero, borrowing is abundant and cheap, and the further it goes down, the more abundant and the more cheap. You can see here that really, for the better part of 3 years here, Chinese financial conditions have been in restrictive territory. They have been tight, choking off growth. And looking at the negative loan growth numbers that we just looked at, you get a sense that officials are not really serious about fixing this by splashing out a ton of money out there, as would be the case were this the US or Europe. There would be aggressive QE efforts were this Japan, let's say, with the United States, Germany, or the ECB for that matter. But that's not what's going on here. And so the economy is seemingly withering on the vine. Now, this is, of course, very bad news for the global economy as a whole. We've talked about this at length, but the global economy basically is powered by 3 growth engines, of which China is the second most important at 18% of the pie. The US is 24% of the pie. The Eurozone is 15%. Collectively, they are 57% of global growth. That actually understates how important they are, because the remaining rest of world 43% mainly depends on demand from the former 3 to have economic growth at all. So they are essentially vendors. Consider, for example, whether Canada even has an economy if it's not exporting to the U.S. Consider what economic conditions look like in Australia if they don't have China as a customer. Consider who Central European countries sell to, if not Western Europe. So actually, the impact is far more than 57%. These 3 economies account for the lion's share of almost everything. And almost every single one of them, of course, including China, are now misfiring. So the inflation numbers suggest anemic demand and an absence of positive contribution or positive prospects from China. That much we've seen at length now. Earlier this week, in fact, on yesterday's show, we talked about the many issues in Europe. That's summarized here by S&P Global's Eurozone PMI numbers, which you can see for 2 months now are under the 50 boom bust level. PMI numbers, as ever, work around that level being neutral. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So in seeing this composite PMI number below 50, what we are saying is that both manufacturing and the service sector are shrinking. So the Eurozone economy, but for a few more months of catch-up data, is almost certainly in recession at this point. It's not much better in the U.S., though in the U.S. it is better than it is in China or in Europe. Here, the growth is still positive, but manufacturing is, of course, still very much in contraction, as it has been since the middle of last year. A pop in the service sector crested in May, much as it did in Europe here. And now, looking at the composite numbers, growth is idling almost. It is very, very narrowly positive, but this is, of course, exactly what the Fed is taking aim at, because they'd like to get U.S. inflation back down to 2%, and they've only figured out one way to do that. There's really only one way that lends itself: holding interest rates higher for longer to squeeze the economy and cause enough economic pain to hurt demand in the labor market and therefore consumption. So as we look at what the three main engines of growth are telling us, what we see is China has lost pricing power and is coming apart at the seams for all the various reasons we've just looked at, not the least of which their reluctance to actually stimulate. We've heard from President Xi Jinping that what he's after is high-quality growth and not low-quality growth, which ostensibly implies investments in more resilience, investments in more long-term drivers of growth, investments in reform. That's all well and good, but the economy needs demand now. And what he's essentially saying is we're not going to have the kind of effort that we've seen out of China before, where a bunch of borrowed money is thrown at big infrastructure projects that gets a bunch of activity going, gets a bunch of people employed, and that creates some greasing of the wheels for the economy to start to turn over. Doesn't seem like the administration in Beijing is of a mood to do that kind of thing here. And so in China, we're seemingly in for a long slog at low growth levels. As we said before, in the Eurozone, we're already in recession. And in the U.S., we're slowing, and the Fed would very much like to continue that and endeavors to set policy such that the slowing is really felt and the labor market really starts to feel the pain and the jobless rate goes up. That, of course, is bad news for U.S. growth, because close to 70% of GDP growth in the U.S. is consumption. No jobs, no consumption. All of this put together means global recession. And the financial markets are beginning to show signs of trading on precisely this basis. And so as all of this evidence comes together, these are the dynamics that we would expect to see. Note here, the S&P in red has been going down despite there being no greater expectation for Fed rate hikes. The big boogeyman indicator for the past year and a half or so, stocks had been moving lower all through last year because the Fed increased the cost of borrowing on everybody at a blistering speed, and other central banks joined it. That, of course, isn't good for economic activity because it became more expensive to finance at every level. What we saw from about October, November of last year through to just about now is a recovery in stocks around the idea that the Fed might be done. In fact, we saw in March and May a real build out in rate cut expectations, that's those gray bars going lower, around the banking crisis, SVB led, and the U.S. debt ceiling debacle. You can see those things have unwound now because those issues have kind of moved onto the back burner, at least near term. But now, even as we get stocks going lower, it isn't rate hikes that's inspiring it. As a matter of fact, there seems to have been a capping of policy expectations well below baking in another rate hike this year. So ostensibly a dovish development, or at least a not hawkish one, and yet stocks are going down, ostensibly for reasons that have nothing to do with the Fed being more tight, but rather with the consequences of the tightness that's already there, coupled with weakness overseas. The US dollar tells this story in spades. It had been supported by rising interest rates because, of course, that increases its relative yield against other currencies. What we see here is it is screaming higher, and not because more rate hikes are on the table. Very pointedly, that hasn't moved. Rather, there is liquidation. People are divesting of their investments and going to cash. And of course, no cash is more liquid than the US dollar. That makes it less volatile when big capital flows move in and out. And so if people are afraid, if they're looking for cashing out, if they're looking for liquidation, if they don't like the state of the global business cycle, well, where are they going to go? They're going to cash out into the thing that's the least jumpy, that's the least volatile, and that will most easily lend itself to reinvestment once whatever storm passes. And there's nothing more liquid than the US dollar, at least not that we know of in this universe. So we are seeing all the hallmarks now, looking at the currency space, looking at the stock space, of things getting defensive, and not for reasons that have been the norm over the past year and a half, but actually for growth-related reasons, it would seem. And as the situation compounds, and we get the kind of numbers that we're expecting out of China on the CPI front, and we get more evidence that this squeeze is getting more adverse and growth is getting more and more hampered, more of the same here, seemingly likely. Weaker stocks and a stronger dollar. With that, there might come expectation for lower yields because central banks invariably do have to cut to support economic activity. In anticipation of that, one might expect the yen to go up. It tends to move inversely of yields and with bonds because, of course, it yields nothing. The higher yields go, the less attractive it is to own yen, and the more attractive it is to borrow yen and then sell it for higher yielding things. Well, when rates stop going up and start going the other way, people typically unwind that exposure. And so the yen tends to go up with the dollar when it's liquidation time. Tellingly, that has started to occur just in the past day or two. So it is possible that it is time for the rubber to meet the road, as it were, and for the markets to trade as though a global recession is on the immediate horizon. And that is macro money for today and for this week. I'll be back with Chris for Futures Power Hour tomorrow. Macro Money will be back next week on its regular Monday through Thursday schedule right after overtime, a show that Chris Vecchio, head of Futures and Forex here, and I do, summarizing what happened on the day after the Wall Street close and then trying to figure out where things might go next. I'm writing for the News and Insights section of tastylive.com and opining on the platform formerly known and perhaps futurely known again as Twitter at Ilya Spivak. Thanks very much for joining, everybody. See you next week for Macro Money. See you tomorrow for Futures Power Hour. Take care.